Welcome back to our second video out of total 3 video of FP&A interview preparations. We will cover technical questions in this video. Similarly, like last video, you can increase the speed if you feel so. Listen at least 2 to 3 times before appearing in interview. Additionally, you can take screenshot of questions and video and go through these concepts just before interview without wasting much time. Let's start. Question 1. What are the steps involved in financial forecasting? Let's understand first. Financial forecasting is like peering into a crystal ball for businesses. First, we gather data, set realistic assumptions, and plan for various scenarios. It's crucial for decision making, guiding us through uncertainties. Think sales projections, budget planning, or risk assessment. By collecting relevant data, setting assumptions, and developing scenarios, we pave the way for a clearer financial future. For this question, when answering, you should explain data collection, assumption setting, and scenario planning. Discuss the importance of forecasting in decision making. Provide examples of forecasting applications. Must give points. Collect relevant data for forecasting. Set realistic assumptions. Develop scenarios for different outcomes. Next question around dividend policy. What are the different dividend policies and how do they impact shareholders? Let's understand first. Dividend policies significantly influence shareholder value and cash flow. The residual dividend policy, for instance, prioritizes reinvestment over payouts, ensuring growth before dividends. Companies like Apple adopt a stable dividend policy, providing consistent returns. Balancing these strategies is crucial. Firms must navigate investment needs while rewarding shareholders effectively. For this question, while answering, you should explain residual dividend policy and other dividend policies. Discuss the impact on shareholder value and cash flow. Provide examples of companies with different dividend policies. Must give points while answering. Dividend policy impacts shareholder value and cash flow. Residual dividend policy prioritizes investment over dividends. Companies must balance dividend payments with investment needs. Next question. What financial ratios and models are used to predict financial distress? Again, let's understand first. The Altman Z-score is crucial for predicting financial distress, combining profitability, leverage, liquidity, and activity ratios. Early detection allows firms to take corrective action before it's too late. By analyzing these financial models, businesses can foresee trouble, like bankruptcies or cash flow issues, ensuring timely interventions and strategic pivots. For this question, while answering, you should explain the Altman Z-score and other financial ratios, discuss the importance of early distress detection, provide examples of distress prediction applications, must give points. Altman Z-score predicts financial distress. Early detection enables corrective action. Financial ratios and models aid in distress prediction. Next question, what are the financial implications of corporate governance? Let's dive into it, the concept of corporate governance. First, corporate governance significantly influences financial implications by enhancing risk management and fostering stakeholder trust. Effective governance practices such as transparency and accountability lead to informed decision-making. For instance, companies like Tata Group exemplify good governance, resulting in improved financial performance and stronger stakeholder relationships, ultimately driving sustainable growth and stability. When answering, you should explain the impact on risk management and stakeholder trust, discuss the importance of governance in decision-making, provide examples of good governance practices. Also below are must-give points. Governance impacts risk management and stakeholder trust. Good governance enhances financial performance. Companies must prioritize transparency and accountability. A very important question around hedging. What are the different hedging strategies and how do they impact financial performance? This is very important concept with respect to FP&A interview. Let's dive into it. Hedging strategies play a crucial role in managing financial risk, ensuring that businesses can navigate market volatility effectively. Cash flow hedging focuses on protecting against fluctuations in cash flows, often utilized by companies with predictable revenue streams, such as those in commodities. In contrast, fair value hedging aims to mitigate the risk of changes in the value of assets or liabilities, commonly used by firms holding fixed-rate debt. Both strategies enhance financial stability, allowing organizations to maintain consistent performance despite external pressures. For instance, a manufacturing firm might hedge against rising raw material costs, safeguarding its profit margins and ensuring sustainable growth. You should include the below points: explain cash flow hedging and fair value hedging, discuss the impact on financial performance and risk management, provide examples of hedging applications, must give points. Hedging strategies manage financial risk. Cash flow hedging and fair value hedging differ. Hedging enhances financial stability. Next question. What are the steps involved in financial scenario planning? For this question, understand concept of financial scenario planning. It is a strategic approach that begins with scenario identification, where we pinpoint potential future events that say could impact our financial landscape. Next, we delve into scenario development, crafting detailed narratives around these identified scenarios, which allows us to visualize various outcomes. The crux lies in scenario analysis, where we rigorously evaluate these scenarios to inform our decision-making process. This method is crucial as it enhances our financial flexibility, enabling us to adapt to unforeseen changes. For instance, businesses can apply scenario planning to navigate economic downturns or market expansions, ensuring they remain resilient and proactive in their strategies. When answering, you should always include explain scenario identification, scenario development, and scenario analysis. Discuss the importance of scenario planning in decision making. Provide examples of scenario planning applications. The below are must-give points. Identify and develop scenarios for different outcomes. Analyze scenarios to inform decision-making. Scenario planning enhances financial flexibility. Next question is, why is financial sustainability important, and what is its impact on long-term financial performance and stakeholder trust? Financial sustainability is crucial in today's dynamic business landscape, as it directly influences long-term financial performance and stakeholder trust. By prioritizing sustainable practices, companies not only enhance their profitability, but also create a resilient foundation for future growth. For instance, adopting energy-efficient technologies reduces operational costs while demonstrating a commitment to environmental responsibility. This in turn fosters trust among stakeholders, including investors and customers, who increasingly favor businesses that align with sustainable values. Ultimately, integrating sustainability into financial management is not just a moral imperative. It is a strategic necessity that drives enduring success and strengthens relationships with all stakeholders involved. Must focus on below points while answering. Explain the importance of sustainability in financial management. Discuss the impact on long-term financial performance and stakeholder trust. Provide examples of sustainable financial practices. Must give point. Sustainability enhances long-term financial performance. Sustainability builds stakeholder trust. Companies must prioritize sustainability in financial management. A simple question around capital budgeting question. What are the steps involved in the capital budgeting process? Let's understand first, capital budgeting is a critical process that ensures a company invests wisely. It begins with project identification, where we pinpoint initiatives that align with our strategic objectives. Next, we delve into evaluation, employing metrics like net present value, also ref as NPV, internal rate of return, also known as IRR, and payback period to assess potential returns and risks. For instance, consider a firm contemplating a new manufacturing facility. We would analyze the projected cash flows to determine if the investment meets our financial benchmarks. Ultimately, the selection phase focuses on choosing projects that maximize shareholder value, ensuring sustainable growth and profitability for the organization. For this question, when answering, you should explain project identification, evaluation, and selection. Discuss the importance of NPV, IRR, and payback period. Provide examples of capital budgeting decisions. Also below are the must-give points. Identify projects that align with company objectives. Evaluate projects using NPV, IRR, and payback period. Select projects that maximize shareholder value. This is our last question for this video, and we will release the next video soon on remaining questions. And post these videos, stay tuned for one more bonus video on FP&A. So, moving to last topic, sensitivity analysis. And question is, what are the steps involved in conducting sensitivity analysis? Conducting sensitivity analysis involves a systematic approach that begins with identifying key variables that significantly impact project outcomes. These variables could range from cost estimates to market demand fluctuations. Once identified, the next step is to create various scenarios that test the robustness of the project under different conditions. This could mean adjusting variables to see how changes affect overall performance. Finally, evaluating the results is crucial. It informs decision-making by highlighting potential risks and opportunities. Sensitivity analysis is invaluable in risk management, as it allows professionals to anticipate challenges and make informed choices, whether in financial forecasting or project planning. Similarly, like other questions, when answering, you should explain identifying key variables, creating scenarios, and evaluating results. Discuss the importance of sensitivity analysis in risk management. Provide examples of sensitivity analysis applications. Finally, below are the must-give points. Identify key variables that impact project outcomes. Create scenarios to test project robustness. Evaluate results to inform decision-making. If you are still watching the video, congratulations. You are quite near to crack the interview and get your dream job. We will soon release third part of the FP&A interview preparation. Finally, a heartfelt thanks for watching Finance Kida channel, and don't forget to like, share and subscribe. Finance Kida channel,